Welcome back, everyone. This is a brief update on news from the oil market. On Tuesday, the American Petroleum Institute released its weekly count indicating that U.S. crude inventories increased by 7.3 million barrels last week, significantly higher than the expected 1.2 million barrels. Not much reaction was viewed on oil prices, even though some pressure was observed upon the release. However, a more detailed fundamental analysis on the oil market follows. Strong production forecasts have been released by U.S. oil giants ExxonMobil and Chevron Corp that amaze market followers and potential investors. The two oil rivals operate within the West Texas and New Mexico field, and with the new production expectations looming, they could act as direct competition to one another. Expectations released by Chevron Corp indicate an increase by 59% of current production levels, reaching approximately 600,000 barrels per day, with that figure increasing by over 30% by 2023, with a steady production rise of 3% to 4% annually. Both Exxon and Chevron have taken actions towards achieving faster cash flows by investing in shale oil producing rather than traditional methods of oil extraction of the past. From a more generic perspective, U.S. oil firms are making adjustments to the way they operate in an attempt to win back investors. The oil sector in the U.S. has disappointed in the previous years, with the energy shares in the S&P 500 index dropping to 6% in 2018 from 8.4% 4 years earlier. On another front, reports from China said the country is planning a huge energy market restructuring. The mainland's intentions are to create a national oil and gas pipeline set, uniting the long-distance pipeline assets of the country's state-owned energy companies. The open pipeline network will give the advantage to companies to concentrate on exploration activities without any additional transportation costs to move the fuel in the market. From the Middle East, Saudi Arabian oil giant Aramco has increased its April price for its Arab Light grade aimed at Asian clients by 50 cents a barrel. This comes after Dubai priced spread widened by 30 cents a barrel in February compared with the previous month. Prices of future months had been uplifted due to stronger demand for spot oil. Furthermore, prices could have been affected by a temporary suspension of the world's largest oil field, Safaniya, which produces heavy Saudi crude. Yet Saudi Aramco's chief executive confirmed on Tuesday that this oil field restarted its operations. As a conclusion, it could be a bumpy ride for oil prices this week, as oil analysts and traders expect updates on the U.S. Sino matter, which could reach a trade agreement prior to deciding on the direction of the crude oil, while the upcoming EIA weekly figure released later in the U.S. session today could create volatility for the commodity. For more in-depth investigation, please refer to our written report, which also includes technical analysis. For more information and trading ideas, you can visit our webpage. Follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+. This is Angelo Zittis from IronFX, wishing you solid trading.